Another fact about the preferred stocks are that preferred stocks are held mostly by other corporations. So 70% of preferred dividends are non-taxable to corporations. So when we consider this, then the cost of preferred stock after tax is the cost of preferred stock originally minus the cost of preferred stock multiplied by 1 minus the 70%. That's because only 30% of the preferred stock are taxable, and that's 40% tax. So after tax, the cost of preferred stock is 7.92%. And remember, for the cost of debt after tax, we have 6% after tax cost of debt. So between the cost of preferred stock after tax and the cost of debt after tax, there is a premium on preferred stock, and we call it after tax risk premium on preferred stock, the difference of 1.92%. So this is considering the fact that only 30% of the preferred dividend are taxable. Now let's think about cost of common equity. Common equity capital can be from two sources: directly by issuing new shares of common stocks, or indirectly by reinvesting earnings that are not paid out as dividends. Remember, if we don't pay dividends, or say if we don't pay 100% of the net income as dividend, then the rest is retained in the company as retained earnings, and that is part of the common equity. It may seem that no cost would incur from this internal financing. However, we need to be aware that there is still a cost of financing by reinvested earnings. If the earnings are not reinvested, they will be paid out as dividends. Investors could use the dividend they receive to buy other securities and therefore earn a return. So there is an opportunity cost for shareholders if earnings are reinvested, which is a return shareholders could earn on investing the dividends. Then shareholders actually would require a return on those retained earnings. So bottom line is, no matter whether the company issue new shares to raise common equity or retain the earnings as part of the common equity is costly for the company because shareholders require a return for their equity investment. We can use three approaches to estimate the cost of equity. The first one is the so-called CAPM model. Second one is the discounted cash flow model, and the third one is called the own bond yield plus judgmental risk premium approach. We'll explain these one by one. So first, the CAPM model. What is CAPM? The capital asset pricing model is a model that describes the relationship between risk and expected return in financial securities, such as a stock. The expected return of a security or a portfolio equals the return on a risk-free security plus a risk premium. The general idea behind CAPM is that investors need to be compensated for two things: time value of money and risk. The time value of money is represented by the risk-free rate and compensates investors for placing money in any investment over a period of time. The second half of the formula represents risk and calculates the amount of compensation the investors need for taking on additional risk. B, or beta, is a risk measure that compels the return of the asset to the market over a period of time. Generally, a beta of 1 indicates that securities price would move with the market. A beta of less than 1 means that the security will be less volatile than the market. A beta of greater than 1 indicates that the securities price will be more volatile than the market. For example, if a stock's beta is 1.2, it's theoretically 20% more volatile than the market. The RPM is the market premium, which is the difference between the expected return from the overall stock market and the risk-free rate of return. So RPM equals to the market return minus the risk-free return. You can refer to this web page for a detailed explanation of the CAPM model. For us, we try to apply the CAPM model to estimate the cost of equity. So if we are given a 5.6% risk-free rate and a 6% market risk premium and a 1.2 beta, we can plug in these numbers into the formula and estimate the cost of equity of this company as 12.8%. For the risk-free rate, most analysts use the rate on that long term, which is usually 10 to 20 years, government bond. Remember from last lecture that the 10-year Treasury bond rate is widely used as a risk-free rate. For the market risk premium, most analysts use a rate of 3.5% to 6% as the market risk premium. So as you see, it is actually a pretty wide range. For the beta is usually calculated using regression analysis. Analysts can use a computer with statistical software or spreadsheet to perform the regression. At least 3 years of monthly returns or 1 year of weekly returns are used, and many analysts use 5 years of monthly returns for the regression analysis. And for the market return, many analysts use the return of the S&P 500 as the market return. You can refer to the Exhibit 2 in the article Best Practices in Estimating the Cost of Capital for some survey result on common practices in applying CAPM model and estimating the VAC. You can try to click here for a YouTube video instruction in using Excel to estimate beta for a stock. If you use Texas Instrument 83 calculator, you can check out the video I uploaded on D2L titled TI-83 Finding Beta. For BA2 Plus users, you can check out the video on D2L titled BA2 Plus Finding Beta. So these videos can give you detailed step-by-step instruction on how to use data and estimate beta coefficient from a regression analysis. The second approach is to use the discounted cash flow method. So for example, if we have the recent dividend of 3.26 per share and the stock price now is $50, and if we assume a constant dividend growth rate of 5.6% for the dividend, then we can use the formula that the cost of common equity equals to D1, which is D0 multiplied by 1 plus G, and then divided by P0, and the result plus G. And when we plug in all these numbers into this equation, we get 12.4% cost of equity. And this formula is simply a reformatting of the stock valuation formula you saw in lecture 5, the constant dividend growth model. So instead of trying to find P using the constant dividend growth model, here we assume that we know P. We try to reorganize the formula and find RS. When a company issues new common stocks, they also have to pay flotation cost to the underwriter, or say the investment bank. Let's use this example to show how to include the flotation cost to estimate the cost of new common equity. If we have price as 50, D0 as 3.12, G is 5.8, and we use a 15% flotation cost, then in this formula you notice that we incorporate flotation cost in the denominator in this equation. So D0 multiplied by 1 plus G, and then divided by P0 multiplied by 1 minus F. Well, F is the 15% flotation cost in this example. So we plug in all these numbers, and it turns out the cost of common equity is 13.6% with flotation cost included. In this approach, we need to know about the growth rate G. So how do we estimate the growth rate? There are different approaches. You can use the historical growth rate if you believe the future will be like the past. So you can take a look at the historical dividend growth pattern and find out the average growth rate in the dividends, and that is a historical growth rate. Or you can go to Value Line or Zacks or Bloomberg to find what other analysts estimate as the company's dividend growth rate. The third approach is to use the earnings retention model, and in this model, growth rate equals to the retention rate multiplied by ROE. So suppose the company has been earning 15% ROE and has been paying out 62% of its earnings as dividend. And if this situation is expected to continue, what is the expected future growth rate? Using this model, retention rate will be 1 minus the dividend payout rate, so 1 minus 62%. And then multiply by the ROE, 15%, so the growth rate is estimated to be 5.7%. So these are different approaches to estimate the growth rate, G, that you need to use in the discounted cash flow model to estimate cost of equity. The last approach to estimate the cost of equity is called using the own bond yield plus judgmental risk premium method. So the idea is actually pretty straightforward. If the company has bond and the bond yield is RD, so own bond yield, and then plus a judgmental risk premium, and that would give us the cost of equity estimate. Notice here that this judgmental risk premium is not the same risk premium as in the CAPM model that we just talked about. This risk premium is simply based on the idea that stocks generally are riskier than bonds, so stockholders would require a higher return, and this higher part is referred to as the risk premium, and it's very subjective or judgmental. So for example, if we assume that the company's cost of debt is 10% and this judgmental risk premium is 3.2%, then the cost of equity is simply the own bond yield 10% plus this judgmental risk premium that gives us 13.2%. And notice here for the RD we use the before tax cost of debt. So now we have tried 3 different approaches and they give us different estimates. So with CAPM model, we got 12.8% cost of equity. With the discounted cash flow approach, we got 12.4%. And with the own bond yield plus judgmental risk premium approach, we got 13.2%. Then we can add up the 3 numbers and figure out an average, and that is 12.8%. That would be a reasonable estimate of cost of equity. So far we have figured out all the R parts in the VAC formula. Remember the RD, RPS, and RS. And then what are left are the W's, WD, WPS, and WS. And they are the weights. So the weights are the percentage of the firm that will be financed by each type of capital. For example, the debt, the preferred stock, or common stock. If possible, we should always use the target weights of the various types of capital that the firm will be financed with. So for example, if we have information that the company plans to finance the project with 40% debt and 10% preferred stock and 50% common equity, those would be the target weights. If we don't know about the target weights, then it is better to estimate the weights using current market value than the current book values. We know for common equity, market values usually differ a lot from the book values. But if we don't know the market value of debt or preferred stock, it is usually reasonable to use the book value of debt and book value of preferred stock. Just remember that for the common equity, it's always better to use the current market value of the common equity instead of the book value of common equity. So here's an example. Suppose the stock price is $50 per share and there are 3 million shares of common stock. The company has 25 million of preferred stock and 75 million of debt. Then the market value of the common stock is $50 per share multiplied by 3 million shares, so there's a total of 150 million market value. Market value for preferred stock is assumed to be the same as its book value, so it's 25 million. And market value for debt is also assumed to be the same as its book value, so the value of debt is 75. Then 150 plus 25 plus 75, that gives us a total 250 million total capital. What is the percentage of common equity? It is 150 over the total 250, so that's 60% weight from equity capital, so that's WS. And for the preferred stock, 25 out of 250, and that is 10%, and that's WPS. For debt, 75 out of 250, that's 30%, and that's WD. And you notice these 3 numbers, when they add up together, that should give you 100% or 1. Here we assume that the target weights for this company are the same as these market value weights. But we also need to be aware that often market weights temporarily deviates from targets due to the change in stock prices. Now, let's put all those previous calculations together. According to the weighted average cost of capital formula, WACC equals to this. So we plug in our estimate of each component into this formula, and 30% is the WD multiplied by 10% multiplied by 1 minus T, so that is 6% after-tax cost of debt, 10% of the capital from preferred stock multiplied by cost of preferred stock, 60% of the capital are from common equity multiplied by cost of common equity, and then we add up these numbers together, we get about 10.38%. That is our estimate of the weighted average cost of capital for this company. Let's think about what could affect the WACC of a company. We say there are uncontrollable factors because they cannot be controlled or changed by the company itself. These would usually include the market conditions, for example, the interest rates. A company usually cannot affect or change the interest rate. The market risk premium, again, that's from the overall market, and it cannot be controlled or affected by the company. And then the tax rate, of course, a company cannot change the tax rate. And then there are controllable factors, which are the factors that the company can change or adjust. So among these factors, we have the capital structure policy. For example, if the company plans to issue more debt, then they can increase WD and therefore decrease WS or WPS. And that potentially could affect the weights and in turn the WACC result. The company also can change its dividend policy, and that would affect their cost of equity and in turn the result of the WACC. The company can also change their investment policy. If they decide to engage in riskier projects, then investors would require a higher return to compensate the risk that they have to bear. Then that also means the company needs to pay for a higher cost of equity, and in turn that would lead to a higher WACC.